Welcome to Blue Nile Tutorials. Today, let's dive into the basics of directors and equity and financial reporting and auditing. These two elements are key to understanding the governance and financial structure of a company. Directors are responsible for the overall management and governance of the company. Their duties include overseeing financial reporting and ensuring compliance with laws and standards, acting in the best interest of shareholders and stakeholders, approving dividends, issuing shares, and managing corporate strategy. Equity represents the owner's residual interest in the company after deducting liabilities. It is found in the balance sheet and includes share capital, the funds raised from issuing shares to investors, reserves, retained earnings, revaluation reserves, and other comprehensive income, dividends, payments to shareholders that reduce retained earnings. Let's break it all down further in our tutorials. This video will cover some practical ideas in how to audit the following areas of the financial statements: the statement of profit and loss, directors' emoluments, and the equity and reserves area. Each of these areas have some specific issues which need to be addressed by the auditor. Remember, much of the transactions in the statement of profit and loss have already been tested via the corresponding debit or credit balance that was included in the statement of financial position. Whether it be payroll, revenue, purchases, or any of the expense accounts, there will already have been some evidence collected that we have already seen. The key assertions for the statement of profit and loss balances are cutoff, occurrence, completeness, classification, and accuracy. The additional audit procedures that should be carried out on these custom revenue balances would include some substantive analytical procedures and some specific audit work to ensure the assertions are verified. For the payroll balance, a few specific audit procedures include: for a sample of employee balances, recalculate the deductions such as the tax and investigate any differences. Agree the net pay as per the payroll records to the bank statements and cash book. And agree total wages and salaries from the payroll system to the trial balance and the financial statements. Analytical procedures for payroll include proof in total of the wages and salaries balance. This is where the auditor will estimate the balance from the information obtained from the client, such as average wages and the percentage pay rise, and compare it to the actual balance. Any significant differences will be investigated. Also, comparing the current year balance to the previous year will also identify potential misstatements, if significantly different. The revenue balance substantive tests include: for a sample of invoices, recalculate the sales tax and discounts for accuracy. Agree a sample of customer orders to the dispatch notes and invoices to ensure they were recorded. And inspect credit notes issued shortly after the year end and the supporting documentation for evidence that they were relating to actual sales and not created to overstate revenue. Analytical procedures would include comparing the revenue balance to the previous year, calculating and comparing gross profit margins to the previous years, and comparing the balance to budgeted figures. The purchase and other expense balance procedures include inspecting purchase orders and agreeing these to the goods received notes and invoices recorded, recalculating sales tax and discounts on a sample of invoices, and agreeing the balance on the ledger to the trial balance and the financial statements. Analytical procedures include calculating the operating profit margin to compare to the previous year and investigating any significant differences, and comparing each expense account to budget to identify anything to investigate further. Directors' emoluments are reviewed for accuracy. Remember that the auditors regards any director's transactions as material by nature, and so must be satisfied that the transactions and disclosures are accurate. An example of audit procedures would be, obtain the detailed list of directors' transactions, which shows the split between wages, bonuses, pensions, etc., and cost it to ensure all of the totals are correct. Inspect payroll records and agree the balances to the list. And inspect bank statements and agree the amounts actually paid. And obtain a written representation from the directors that they have included all directors' remuneration to the auditor. The equity section of the Statement of Financial Position will include the following balances: share capital, dividends, and other reserves. The financial statements will also include the statement of changes in equity, which will show the movement in these balances from the beginning of the year. For each of these balances, ensuring the closing position agrees with the trial balance and the statement of financial position will be important. To audit share capital, the auditor will need to inspect share certificates or other official documentation and agree to disclosures made in the financial statements. Inspect board minutes for evidence of a share issue. And inspect the cash book for evidence of money coming in from a share issue. Dividends paid and included in the financial statements will require the auditor to inspect board minutes to ensure the amount and the date declared was before the year end. Inspect the bank statement and agree the amounts paid and that they were before the year end also. Other reserves could include the revaluation reserve as an example. To audit this balance, the auditor must ensure that the opening balance agrees to last year. The movements in reserves add up to the closing balance, and that any movements agree with supporting documentation, for example, a valuation report. There are many examples of good substantive audit procedures to carry out on individual balances within the financial statements. Having a strong understanding of the financial statements and how they are prepared will help you remember the key audit procedures that help identify material misstatements. Analytical procedures feature as a key substantive procedure for many of the balances included in these videos. These procedures allow the auditor to assess the risk of misstatements being present so they can decide whether to investigate further. Practice makes perfect. Reviewing procedures and practicing questions will ensure you retain this knowledge and grow in confidence. I hope you found these videos useful.